Morning, everybody. Thank you for joining the ACA Small Business Bootcamp for this Tuesday, March 30th. We're glad to have you join us this morning. We have a great session planned for today. As always, I'm Robert Theobald, the Small Business Ombudsman and Vice President for Small Business Services here at the Arizona Commerce Authority. And we always like to start the boot camps recognizing our community partners. We could not do these boot camp sessions without these community partners with their expertise, their presentations, their guidance, their time and their efforts. So we appreciate them very much for helping us put these on. So the Small Business Bootcamp and Resource Collective is designed to help small businesses work through the COVID crisis. They are supported by our community partners throughout the state. And aside from being just the boot camp, we do provide a resource collective. So on the Small Business Bootcamp website, you can find a lot of great information. This is one of those websites I recommend you favorite and having your easily accessible in your browser. On this, you can see the current session and the upcoming sessions to register for those. And as well, you'll have a link to the resource collective. And then the most valuable piece on this page is our archive. We have recorded all of our previous bootcamp sessions and list them in the archive so that you can go back and access them at any time. There's over 140 sessions included in the archive, making it a very large library of knowledge that is available at no cost to anyone looking to gain some more information for their business. As I mentioned, we have the Resource Collective on there as well. And the Resource Collective is a website that we've set up that provides the tools and resources provided by our community partners. There's guides and other reference materials. And this is just a sample of those items that you can find on the Resource Collective. Things such as the unemployment insurance guide, safe retail, construction industry information, manufacturing, cosmetology, etc. There's a lot of great information that you can find on that Resource Collective to help support your business. Additionally, our Arizona Commerce COVID-19 Arizona Business Resources page is a great website to be aware of. You can find business guidance information on there. You can find funding or financial resources as well. Anytime a new grant or program comes out, we link it to that page, and we try to keep it updated as often as new information comes out. Additionally, the ACA has a number of programs to help support small businesses. Our small business services can help you with navigating through the SBA, connecting you to work with the SBDCs or the SCORE. If you have questions about lending, we can connect you with local banking contacts. Our workforce division works with employers that are looking to hire and grow their staffing. They also have programs to help with employers that are looking to upskill their employees. And then our Arizona Manufacturing Extension Partnership supports the manufacturers' needs during the COVID-19 crisis. It can also help with a number of different training and development programs that they have for small and mid-sized manufacturers to help them grow and develop their business. Additionally, for those looking to start a side gig or start a small business, we have our small business checklist. And this is good for any business, whether you're going to start a small or large business. And it's an online interactive resource to help businesses understand the licensing, registration, and compliance needs at the local, state, and federal levels. There's also business planning, development, and procurement and marketing opportunities that you can find on that checklist. It is a great resource for small businesses. And then finally, the last website I want to mention is the state's COVID-19 information and resource page, arizonatogether.org. You can find a lot of great information related to COVID-19 on this page. With that, I want to transition over to some quick updates. If you have a shuttered venue, an event venue, museum, music venue, theater, the SBA has announced that on April 8th, the shuttered venue operators grant will open. They have listed here is the link to the application, and we'll post this in the chat for you so you can access it. You can start working on the application now. You can't submit it until April 8th, but there's a number of key things in there you want to start working on now. It's not going to be just a quick thing you can do in a few minutes. So you want to take your time to look at it and start working on that. Additionally, the SBA set up a new Community Navigators website. We've listed it here. It's a new program that they've set up. So we'll list all these links on this page. We will list in the chat so you can access them. Also, it was announced that the SBA has increased the economic injury disaster loan limits. And based on the guidance from the SBA, is they will be reaching out to businesses with information on how to increase your EIDL loan if you have one and are interested in that increase. They'll contact you with that information. The IRS has also extended the tax deadline to May 17th, so you don't have to scramble over the next 16 days or so to try to get your taxes done. And then for those in the area, the Globe area, Globe Miami area, on April 20th, the town of Globe is hosting a Small Business Resources Summit. It will be from 4 to 7 p.m. at the Miami High School Gymnasium. This is going to be a great event for those in that area. And I will be up there in person as well, participating in that event. So come and stop by and see me and say hi. So those are the updates for now. So with that, I want to look at this week's sessions and next week's sessions. So this week we have Understanding Small Business Loans. It's going to be a great session with Karen Burns from the Pima SBDC. Thursday, we have Carrie Ann Todd from Beach Fleischman, who, if you've been with us before on the Paycheck Protection Program boot camps that we've done, she does a phenomenal job, and she's going to share some updates to the program and touch on the employee retention credits as well. And then next week on April 6th, we've got a great panel of no-cost business support programs. These are programs that small businesses can take advantage of, and we want to share that information with everybody and have those programs on here to talk a little bit about what they do and how you can access their programs. I do have to make a note of a correction in here. It's not the Arizona Hispanic Chamber of Commerce, but it's actually the Women's Business Center will be the organization on there with SBDC and SCORE. And then on Thursday, we're, as part of the Startup Together Arizona month, focusing on starting businesses, we are going to have Scott Layden from SCORE go through on how to start a small business in Arizona. It's going to be a great session as well. So with that, we're going to introduce today's speaker. We have Karen Burns from the Pima Community College Small Business Development Center. Karen's an expert in the banking field. She's been a long-time banker and now uses her expertise to help small businesses at the SBDC. So with that, we're going to go ahead and turn the time over to Karen and let her get started.
So good morning, everyone. My name is Karen Burns, and I'm with the Small Business Development Center in Tucson, Arizona, that covers two counties, Pima County and Santa Cruz County. The SBDC network is statewide. We cover every county in the state. We offer no-cost business advisement. If you have management questions, if you have lending questions, if you're trying to access capital and you need to do loan packages, if you need help understanding business plans or financial projections, we're here for you. You can reach out to me, or you can look at our network site, which is azsbdc.net, and you can register for advisement on that site. Again, it's no cost. It's a national program, and we cover the entire state of Arizona. But I'm covering two counties down in southern Arizona. So if I could have the next slide. A little bit of background on me. I was a commercial banker for about 20 years of my life. Worked for some large institutions that traded on the New York Stock Exchange, worked for the federal government, and worked for state government at one point. I've been with the Arizona Small Business Development Center network in Tucson for the past 9 years and have gotten the hang of running a portfolio down there for them. In all of our offices, there are multiple people located, so you have a good chance of reaching the person that can help you the most. Next slide, please. So today we're going to discuss the various types of small business lenders and the loans that they offer. Commercial lending is a little different from consumer lending in that most of the underwriting or the risk decision-making that a commercial lender makes is done on a customized basis. Sometimes you walk into a financial institution and they say, oh, 60-month loans for brand new cars at 2%. It's kind of like the deal of the day. That's not custom underwriting. They can usually decision those loans in a couple of hours. They run a FICO score, they look at your track record, they figure out what kind of car it is, they look at your debt to income ratio on a monthly basis, and they kind of decide very quickly if they can do that loan. Commercial lending isn't really done that way. Every deal is considered unique. And so you've got underwriters who are looking at your deal specifically to see what all the bells and whistles are and what they can do in terms of risk management to determine if your request fits their risk profile for lending. What we're going to do today is we're going to talk about several tiers of loans. And the way the tiers work is we're going to talk about the least expensive money first and work our way down the tiers to the more expensive money. Now, I want to say something. When you look for funding and you're talking about commercial loans, you're talking about promissory notes. So if you think about a balance sheet for a business, you've got the assets, the things that the business owns. You've got the liabilities, the things that the business owes. And the difference between the two is the net worth of the equity in the business. That's the owner's section of the business. We're talking about the liability section of the balance sheet today. We're not going to discuss things like venture capital because that's the equity section. Okay, so let's keep going and talk about how loans are priced and what the tiers of loans actually are. Next slide, please. So there are basically two kinds of lenders, and some of them are hybrid, of course, but it's a cash flow lender versus a collateral lender. Your less expensive loans are often with cash flow lenders. They are relying on the cash flow of the business to repay the loan as their primary source of repayment. They may underwrite and for a secondary source of repayment and a tertiary source of repayment. In other words, liquidation of collateral, going after the guarantors of the loan to see if they can recover their funds that way. But primarily, they're relying on the cash flow of the business. Cash flow is the thing, it's different than profit. So profit is a bottom line number on the income statement. The cash flow is how you pay your employees on Friday and you pay your rent on time. And they're really not the same thing. So when they're looking at cash flow, they're trying to figure out if the business can generate enough cash to pay all of its required obligations plus the loan. Okay. So lenders that charge lower rates and fees are often cash flow lenders. They're making what they think are less risky loans. They may take collateral, but they're taking it more as an abundance of caution and to control the borrower's behavior. Once the collateral is pledged, it becomes a public lien, and other lenders may not be willing to lend at that point. When you pledge collateral, it's often a form of collateral pledge that's called a blanket lien. Usually starts with the word all. It's filed with the Uniform Commercial Code system, which exists in every state in the United States. Arizona's UCC system is very functional, and it allows someone to, quote, perfect collateral. In other words, they can make the collateral public knowledge, so they have perfected their liens. Collateral that does not have perfected liens is not really, it's not public knowledge. Lenders that focus more heavily on collateral lending as opposed to cash flow lending are often more expensive lenders. What they're doing is they're literally lending against the collateral. They're margining against the collateral. For example, if I were to say, I'm going to pledge this ring as collateral, and no one asks me any other questions about my balance sheet, my income statement, my personal financial situation, they just look at the ring and value it. And they say, I'll give you 70% of what I believe this ring's value is. That's a collateral lender, period. So we're going to go through all the tiers and talk about all the different kinds of lenders. Next slide. So loans are priced according to the lender's perception of risk and the lender's cost of funds. If you think of a commercial bank, banks are constantly buying market money. They're paying for certificates of deposits. They're paying for savings accounts. This is the interest rate that they're paying out, and all other forms of ways of acquiring deposits. But they can't just sit on money because they're financial intermediaries. They need to move the money from whatever mountain of funds that they have acquired into something that will provide an investment for the owners of the bank, usually stockholders. And so they tend to move the money into loans, lots of different kinds of loans. It could be a consumer loan, like a motorcycle loan or a residential loan, or it could be commercial lending. So what they're doing is they're saying, how much do we have to pay for the money? And what's the spread that we can lend it at? And how much risk are we willing to take? So I've listed here a whole series of different ways that you might borrow money, because this conversation is about borrowing money. Interest rates and fees get higher the lower we go on the chart. So you can see each level of lending that we're going to discuss today, and then we're going to go through and talk about them. Next slide. Friends, family, and private parties. This is often your least expensive form of lending in terms of fees, interest, liberal repayment. However, it is a form of lending, and it may be interest-free, fee-free. Maybe your great aunt says, I'll lend you $10,000 to buy a piece of equipment, no interest, pay me when you want to. But there's a personal relationship price. If you never repay your aunt, that might be a problem inside the family, and maybe you're not going to get invited back for Thanksgiving dinner. There's a price for money. It can be relationship price, it can be hard dollars, but usually the funds don't move for free. There is a difference between handshake agreements and formal promissory notes. Formal promissory notes are written documents. They're signed by the borrower. They have a date, they have a dollar amount, they have a price for the money, which is usually an interest rate. They may include other items that the lender wants to enforce, but it is a legal document and it is enforceable in court. Small things go to small claims court, larger things can be enforced in superior court. It is basically the lender and you signing a contract that the lender will be paid on time and properly. Handshake agreements are a little different. If someone says to you, I'd like to lend you some money, we don't need any paperwork, that agreement is probably not going to be enforceable in court. It's actually considered more of a gift. Now, you may feel a moral obligation to repay that loan, but there isn't a paper document sort of ratifying the transaction. So a lot of times, if it's gift funding as opposed to a signed promissory note, that funding goes directly onto the business's balance sheet as an asset, but it doesn't have a loan associated with it on the liability of the balance sheet liability section. That means it increases the equity in the business. Okay, next slide. So I want to talk about traditional commercial bank lending. These are banks that are insured by the FDIC, Federal Deposit Insurance Corporation. They might be credit unions, which have a different insurance agency, but also federal. These are portfolio loans oftentimes. In other words, they're not going to be resold. They're going to be held by the bank. Here's the difference. If you have, say, a 30-year fixed rate interest residential mortgage, that mortgage might be sold. You might get a notice after you get it, maybe 2-3 months later, that says the new owner of your mortgage is, and it's not the entity that you borrowed with. And then it says, send your checks here, and that's the servicing area. Commercial loans don't tend to be sold. They can be, depending on the terms of the promissory note and the loan agreement, but usually they're retained by the bank. And so they're called, or lender, they're called portfolio loans. Generally, this is relatively inexpensive money in the market. It's often priced at a fixed rate if it's for term financing, or a variable rate if it's revolving lines of credit or straight lines of credit. Variable rate loans are often priced at a base plus a percentage. So it looks like Wall Street Journal Prime plus 2.5, LIBOR, which is the London interbank rate, plus and a percentage. And that rate might float on certain loans, especially short-term lines of credit. Short-term being, of course, defined as a line of credit that matures in 1 year or less, as all short-term assets are defined. Commercial lenders fund these loans to borrowers they perceive to represent the least amount of risk of default. And you have to think about commercial banks especially. They're owned usually by stockholders, and the stockholders want two things. They want a return on their investment because they bought the stock, and they want the dividend that hopefully that goes with it. And they also want the stock price to go up so that the value of the asset that they purchased increases over time. Commercial lenders are very cognizant of their stockholders and what their stockholders want. And so they tend to take as little risk as possible because defaulted loans affect stock prices. That means that sometimes startup businesses, early stage businesses, undercapitalized businesses might have a difficult time accessing traditional commercial banking money. That doesn't mean that they can't access funding on a debt basis, but it does mean that they might have to go to a different tier to get there. It's actually rather common for a financial institution to say, we don't really do those kinds of loans. We'd like to talk to you when you're 2 years in business. That leaves you a gap if you're at early stage startup pre-venture to find funding on a debt basis. Next slide, please. So the second tier of loans, which the pricing is very close to market pricing, although sometimes it carries higher fees, is what they call government guaranteed loans. These are from the US federal government. You most commonly have heard of them as Small Business Administration guaranteed loans and United States Department of Agriculture guaranteed loans. The guarantee is kind of an interesting thing. What it is it's a percentage guarantee on the daily outstanding balance of the loan for the benefit of the bank or the lending institution. So say a lending institution made a $100 loan and they had a 70% guarantee on that loan. That means the very first day that they fund, $7, 70%, or $70, 70% of $100 is, quote, guaranteed by the US federal government. In other words, if the loan defaults on the very first day and they make all their efforts required under the contract to collect the loan, they may be able to recover 70% of the outstanding principal from the US government. But remember, the US government is us. It's not magic money. It's money that we paid in on our taxes. Why would the government guarantee a loan to a bank? And the reason is this: they want to induce the financial institution to make a loan that the financial institution might normally decline. In other words, the federal taxpayers are splitting the risk of making the loan with the institution. this encourages the institution to take a little bit more risk. This is a very good thing if you're a startup, an early stage business, or you have really tight cash flow. The other thing about these loans is that they can be projection based. So if you are a startup and you don't really have the business, it doesn't have a lot of legs on it yet, you can sometimes access these loans through financial projections. Now, of course, they're still asking for all the basic things. They want to know who the owners are, who the guarantors are going to be on the loan, and they want to know that those people have good credit. So you still have to watch your things like your personal FICO scores for you, and if you're married, for your spouse and any other owners that own 20% or more of the business. But it offers a way for small business to access capital when they might not ordinarily be able to. Banks, credit unions, there are some nonprofit lenders, certified development companies, alternative lenders can participate in this program. Every institution, however, does not participate. So you would have to go to the institution that you were interested in working with and ask them if they offer SBA or USDA loans. Next slide. I think we covered this already. It is interesting, though, that we have nonprofit lenders, and we're going to get to that in just a minute. Next slide, please. So nonprofit lenders and alternative lenders, sometimes they have a social justice mission, sometimes they're simply traditional businesses, but they may be able to accept higher levels of risk. Each of these tiers of lending that we're discussing today is taking a certain slice of the market. And so these lenders are interested in a slice of the market that the commercial banks aren't taking, basically. They generally charge slightly higher rates, sometimes much higher rates, and they may have additional closing fees. But they are sometimes more liberal in their loan requests, and they may be willing to go partially unsecured or accept what you call non-traditional collateral. So let's talk about non-traditional collateral for just a second. Traditionally, collateral is cash, furniture, fixtures, equipment, contracts, rights to payment, accounts receivable, inventory, all the things that are on the asset side of the balance sheet. Non-traditional lenders may be willing to, say, take a piece of jewelry that's been appraised as collateral, and they might take physical possession of it. They might take a historic car that the owner of the business has as collateral. They're taking what we would call non-traditional collateral. They won't always do it, but you can sometimes negotiate that. Next slide, please. There is another tier of lending, and that is called factoring. Factoring most often involves accounts receivable. The financial contract is still a loan, but what's happening is you're basically selling your accounts receivable at a discount. So say you sell, maybe you're a retail computer store, and you sell a computer for $1,000. And the person that buys it says, I'll pay you in 15 days. But the problem is you need the money now because your cash flow is really tight. So you turn around and you go to a factory and you say, I have an account receivable. I'm owed $1,000, but I will sell it to you for $800. They're margining against their account receivable. That gives them the cash within a day or two, but they give up a percentage of what they would have been able to collect probably had they been able to wait for the cash. Factoring is, it's relatively expensive. It's very, very efficient. It does improve cash flow. Mostly, I don't recommend that people use factors for long periods of time because you give up such a high percentage on the margin and the cost is higher. But if you're in a tight situation and you just need to improve cash flow really quickly, factoring is a legitimate way to do it. And there are factors all over the United States that can talk to you about this. Factoring is usually not done by commercial institutions or other kinds of nonprofit lenders. It's usually specific to a certain part of the industry. Next slide, please. There's other forms of asset-based lending, and it's usually margining against collateral. Lenders that focus on asset-based lending are not always as focused on the cash flow of the business as they are the value of the collateral. And they're really interested in the liquidation of the collateral and how quickly they can take control of it if the loan defaults and convert it to cash for repayment. Sometimes asset-based lending is last resort lending. You just need to do something, you need to do it right now. You're just maybe trying to save your business. Once a loan is made, it's relatively difficult usually to renegotiate the terms or modify the loan. And generally, if there's an event of default, the collateral is forfeited to the lender. Again, all these forms of lending are done on promissory notes. So they're basically contract rights for the lender to be repaid and enforceable in court. Next slide, please. So my name's Karen Burns. I'm with Pima Community College, Small Business Development Center down in Tucson, Arizona. As I said, we're a statewide organization. You can go to azsbdc.net and see all of our locations. The things that we talked about today are things that SBDC advisors are very, very good at handling. So I suggest that you reach out if you need a little help with your business. We work with startups, early stage, and very settled businesses. And we do all kinds of work that's really relevant and can help your business operate more smoothly and make you a success. All right, Bob, I'm going to turn it back over to you.
Excellent. Thank you, Karen. Great information. So everybody, we have some time for some question and answers. So let's utilize the Q&A box at the bottom of your screen. So if you have questions about lending for Karen, please post those questions in the Q&A box. While you're doing that, we're going to throw up a poll with 3 questions about lending that we're practicing with this poll option that Zoom has. It's a feature that we haven't used much, but is on there, so we want to give it a try today. So Lisa's going to put the poll up and see if you guys can answer it real quick for us. So have you ever received a small business loan? Just click yes or no, and we're going to see that populate in there. All right, let's jump over to the next question. Actually, you can share the results real quick there, Lisa. So 63% have not, 38 have. So thank you for sharing that. So the next question up. Is, have you received a PPP loan? All right, we got a pretty big percentage that have not. So if you have questions about PPP loans, you can reach out to Karen. You can join us on Thursday for our PPP bootcamp session that we'll be doing to find out more about that. But all the SBDCs across the state can definitely help you if you're looking for a PPP loan as an option with your business right now. So let's go to the next question, our last question on this part. Have you received an economic injury disaster loan, an EIDL? And we have a majority that have not. So if this is a program that you might be interested in, again, the SBDCs can help guide you on this. Or you can reach out to myself and I can give you some guidance on how to go about accessing this loan program, but it is a federal program that is still open for the pandemic. So thank you for participating in these poll questions. We appreciate that feedback, and we have some questions here in the Q&A. So we'll jump into the Q&A. Lisa, thank you for sharing those polls. So our first question, Karen, is if a startup business buys an existing business for lending purposes, would they be considered a startup?
It depends on how you buy the business. So there are basically two ways to buy a business. One is to say, I'm buying the whole enchilada. I'm buying the assets and the liabilities. When you do that, say the business is incorporated, it's a stock organization, or it's a limited liability company, an LLC, you're saying that you're going to buy everything. Most businesses are not bought and sold that way. Usually what you do, and a commercial attorney can advise you, which I am not a commercial attorney, but usually businesses, it's an asset purchase. So you're purchasing the assets of the business and setting up a new business. If you are setting up a new business, it's new. If you are buying all of the assets on the balance sheet and all of the liabilities, then it is a business that's just changed ownership. So why does that matter? It's actually kind of an interesting question. If you are starting a new business and buying assets of another business, then you've established a new LLC. So say your business that you want to buy is called Green Tree Automotive. And you decide that you want to buy the assets only of that business, but not the liabilities, not the debt, and not the unknown contingent liabilities in the business. Then you would set up a new entity, possibly ABC LLC. You would buy the assets of the business and you would buy the name rights of the business, which is an intangible of the business. And your new business then would be called ABC LLC, doing business as Green Tree Automotive. It's a little safer to buy assets only. However, from a lending point of view, they view it as a new business. If you buy the whole enchilada, the balance sheet, all items, assets and liabilities, then you're buying an existing and ongoing business, and you're simply new ownership. Commercial lenders understand the difference, and it's in every situation it's different. I think I told you custom lending is really how commercial lending gets done. So I would say talk to your commercial lender and see which version of this they would recommend. But I also think it's a legal question, and I would advise you to seek legal counsel before you make your final decision and to talk to your business accountant.
Excellent, thank you. We have another question from Pat, and I'll go ahead and answer this. This question is, can you apply a second time for an EIDL loan increase? Pat, if you go, or anybody else looking at that option, if you go to the Economic Injury Disaster Loan website on the SBA website, they have a frequently asked questions link. And that frequently asked questions has a tremendous amount of information. It directly addresses how to ask for an increase to your PPP loan. And also, if you got one and were denied, it has how to request a review of your application. Also, with the direction that came down on the increase in the amounts that I mentioned in the updates, the SBA will be reaching out to businesses directly on how to apply for that increased loan amount to cover 24 months instead of the shorter period originally specified in that program. All right, we've got one from another Bob we have on the call, so thank you, Bob. It says, I have an equity investor set for my company. There are 2 requirements for us to handle, and we are in need of a loan for $350,000. What program is available for financing, and can I use the contract of the equity investor as collateral?
You might be able to. Again, this is a question that you would take directly to a commercial banker. An SBDC employee like me or whoever is in your county can help you figure that out. It depends on how the contract is written and what the lender's interest is in engaging this. Commercial loans are all custom. So what I would say is get a copy of the contract, which you probably already have, go get some advice on it, and talk to a commercial banker. I'm going to say something about talking to commercial bankers. This is what people commonly do. They walk into a branch and they say, I need to talk to somebody about a business loan. If you're doing a loan, say under $250,000, that actually makes some good sense. Higher level loans, you might want to talk to a different kind of commercial lender in the bank. And SBDC personnel usually know most of the commercial bankers that are operating in their counties. So they can help you find the right person for you to talk about or talk with. It's interesting that when you're talking to a commercial lender, you might want to approach the conversation as I'm seeking information rather than I'm asking for a loan. So when you get to the right person, you would say, I'd like to talk about this. Is there anything here that you could help me with? As opposed to, I need a loan for $350,000, which is a whole different way to start the conversation. A little insight into commercial bankers, because we tend to be risk adverse, because our employers ask us to be, is to approach the conversation in a conversational tone, as opposed to just an ask in the first 5 minutes of the conversation. Because what you're looking for is actually a strategy and some kind of structure that might work. And you may have to talk to multiple people before you find that.
That's great insight, Karen. Thank you. Okay, our next question is from Linda. How important is it that all owners have reasonable, good credit when applying?
Okay, so the rule of thumb for most commercial lending is that any party that owns 20% or more of the business is going to be a guarantor. Those who own less than 20% of a business are probably not going to be asked to guarantee the loan. They can still volunteer to guarantee if it adds to the loan's likelihood of getting approved, but they aren't going to be requested for that. It's interesting in the state of Arizona because this is a community property state. So if you are married, that 20% ownership is not just you, it's you and your spouse. Sometimes people say, my spouse owns 20%, I own 20%, and my Uncle Harry owns the other 60%. Therefore, do we all have to guarantee? And the answer is yes. Or perhaps you own 20%, your spouse doesn't really own any of it legally, but because you're a marital community with shared assets in the state of Arizona, your spouse is going to be asked to guarantee as well. So what are they looking for in guarantors? They're looking for good FICO scores. That's sort of the first threshold. They're looking for people, if they have difficult things that appear on their credit reports, bankruptcies, foreclosures, forfeitures, things like that. They want an explanation in writing as to what happened and how it was resolved. Most lenders won't lend into an active bankruptcy. It needs to be fully discharged. There are some no-goes on a credit report, unpaid federal, state taxes. It's going to be very difficult to find financing from a traditional lender. Unpaid child support, certain kinds of felony convictions. And those things actually do appear on credit reports, interestingly enough, and those items don't drop off. When you're talking about FICO scores, high scores are usually around 850 for FICO. Low scores are, under, say, 600. The sweet spot for most lenders is around 700 and above. What is a FICO score? It's kind of an amalgamation of how you've handled your credit personally in the past 7 years. So each month, a new month is appearing on your credit report, and an older month back 7 years is dropping off. It's a risk score. So your credit reporting agencies, TransUnion, Equifax, that kind of thing, they have contracts with Fair Isaacs Corporation, FICO, that allows FICO to mine their data and create a risk number that indicates how you as an individual repaid your debt over time and whether or not there were, negative occurrences on your credit report. Some people are using things like Credit Karma to track their credit. And it's interesting, Credit Karma is valid in the sense that it shows how you're improving over time with your credit. But remember, your commercial lenders don't use Credit Karma. It's a different score and it won't look like a FICO score. So it's sort of that old adage, know the answers to the questions before somebody asks you. If you've never pulled your own credit report or haven't pulled it recently, you probably want to. If you're married, you probably want to do that with your spouse. You'll have two separate credit reports that are tracked by Social Security number, and print it out and look at it. You can order them for free once a year at www.annualcreditreport.com, which is a service of the US federal government. One free report a year per person. I would say print it out, get a ruler, and force yourself to look at it one line at a time because it's data rich and you want to look at every line and see what it says. You can also pull your FICO score if you want to off the internet. Sometimes you can pull it free with financial institutions that you bank with, or sometimes with credit card companies whose cards you use. So I would say get your FICO score for all parties that have 20% or more, or are part of a marital community that has 20% or more, and get the credit reports on all those people. Look at it first so that you know the answers before the banker asks the question.
Excellent. Thank you, Karen. Great response. Appreciate that. So we have another question here from Bob. It says, we are a full C corporation. Can we use stock, or can stock be used for collateral against a loan?
Again, it's an underwriting risk management decision that the lender has to make. There are lenders that will consider that. It sort of depends on how the stock is valued. In other words, if the company is relatively small and there's no real market for the stock, that may affect the lender's willingness to accept it as collateral. But remember, lenders are, depending on the tiers of lending, and you can go back to the screen and look at it, the upper tiers are lending against cash flows. So collateral would be an abundance of caution. If you just want a margin directly against the stock shares, then you're in the lower tier categories that we went over. If it is not easy to buy and sell the stock shares, in other words, there's no active market for that particular stock, then it may be harder to induce a lender to lend against it.
So, and then also another question, will lenders enter into convertible notes for loan purposes?
Most of the lenders that, I'm going to talk about my region, which is Southern Arizona. It's Pima County and Santa Cruz County. Most of the lenders that we have down here would probably not enter into that transaction. However, Metropolitan Phoenix is a much larger market and they might be interested. So depending on where you are in the state, you may want to reach out to the SBDC in Metro Phoenix to see if they can source a lender that might be interested.
So thank you, Karen. So if anybody has any last questions to drop into the Q&A, we've had some great questions so far. So thank you for all those that shared your questions with us. While we're waiting, we'll go ahead and give everybody a reminder for this Thursday's session, talking about PPP updates and the employee retention credit. Please join us for that. If we don't have any more questions, I'm going to go ahead and Karen, thank you for sharing your time with us and this great presentation and your knowledge about lending. I really did like what you said about how to approach the lender and using the right terminology and going in and discussing. If you've been with us for a while on boot camps and you've heard some of our sessions, we've talked about the relationship you have with your lender is very important. And it starts with just those conversations. And so you can pose the scenarios without just going, hey, I need money, please give me money. Thank you for that insight, Karen, on how to work with the lenders. That's very important. I once heard someone say, in order to get money from the banks, you have to be able to speak bank, the language of bank. And there is an important language in there and understanding how it works. So we appreciate your insight. With that, we don't have any more questions, so we will go ahead and give everybody a few minutes back in their day. And we will see everybody on Thursday. Again, thank you for attending today. Have a great afternoon and a great day. Thank you. Thank you, Karen.